Hey, Profit Powerhouse family, are you looking to unlock new financial opportunities? The stock market has been a roller coaster lately, and today, we're diving into the key insights you need to navigate these wild waters. With the S&P 500 and NASDAQ making big moves and gold prices seeing some fluctuations, it's time to take a closer look at what's driving these changes. Stick around to uncover expert predictions and strategies that can help you make informed decisions. Good afternoon, everyone, and welcome to Stock Market Today for Tuesday, March 4th. It was a topsy-turvy day in the markets with an attempted rally off oversold levels. But ultimately, the market closed lower as it continued to chop down. Joining me now to discuss the day's action is my colleague, Ed Carson. Ed, what do you have for us today? I want to take a look at three stocks: Rye, Lifetime, and Netflix. These are holding up better than most and could be good additions to the watch list. But first, let's dive into the major indexes from today's session. Looking at the NASDAQ Composite, it was down almost 0.4% for the day. There was an impressive upside reversal earlier, but it faded in the last half hour of trading. Meanwhile, the S&P 500 was down 1.2% and touched its 200-day line. The Dow dropped 1.6%, and the Russell 2000 was down 1.1%. So, Ed, while the NASDAQ was the least affected, it still looks quite vulnerable and damaged. Yeah, it was down more than 2% earlier, then up over 1%, but ultimately finished lower. It didn't regain the 200-day line, which is a key factor. Even if it had closed at the highs, it wouldn't have meant much. We saw something similar on Friday, where there was a strong gain, but it was just a blip. In a weak market, this kind of fluctuation is common, and we haven't seen a shift in momentum to the upside yet. The conditions are still negative, that's true. And while the market has seen some strength today, it hasn't been enough to shift the broader trend. This is a tricky environment, especially for those tempted to buy the dip. We've seen opportunities in the past, like last August, but right now it's unclear if we're headed for more prolonged chop or a downtrend. It's hard to tell exactly. It's critical to wait for real follow-through before jumping in. Right now, we're in a situation where buying at the low could lead to more losses, so it's a time for caution. We might be in a correction, and there are a lot of negative factors playing into it. That's a significant level to watch. The 200-day line often serves as a last line of defense, and a break below it could signal deeper trouble. If it holds, that would be a positive sign, but it's not guaranteed. We're seeing the market undercutting key levels, and this could be a more prolonged downturn. The Russell 2000 has already broken its 200-day line, and is now down to levels last seen in September, which is concerning. We're also seeing some interesting action in Treasury yields. Even though the 10-year yield has pulled back, it hasn't provided much of a boost to equities. Exactly, it's more about economic concerns now than inflation cooling down. With fears of recession or stagflation, it's not surprising that the yields are showing such weakness. This just adds to the uncertainty. Financials, a sector that was holding up well, took a hit today with XLF down 3.2%. Yes, this is a reminder that even sectors that were relatively strong are showing cracks now. It could be a sign to cut exposure and go into cash. The weakness is widespread. Next, let's look at some individual stocks standing out, starting with Stride LRN. This is showing strong relative strength, and the RS line is at highs. Yes, Stride is holding up well. The stock has been showing strong volume and relative strength. If it can hold its ground in this weak market, it could be a good pick for those looking for stocks with solid potential. Lifetime Holdings LTH is also holding up well, maintaining support at its 21-day line. Lifetime is another stock to watch. It's showing solid growth with strong earnings. It may take some time to form a base, but it has potential. The relative strength is solid. Lastly, Netflix NFLX is showing one of the strongest technical setups among large-cap tech stocks, finding support at its 50-day line. Netflix is a great example of a defensive stock that's holding up well. It's unlikely that people are going to cancel their subscriptions, which gives Netflix some insulation from broader market issues. It's a solid stock, but if the market sells off further, it could break its 50-day support. In conclusion, it's a tricky market, but there are still opportunities to be found by focusing on relative strength. We'll continue to keep an eye on the stocks showing resilience, absolutely. The key is to be patient and focus on stocks that are holding up well while the market figures itself out. If you're enjoying the analysis so far, make sure to hit that like button and subscribe to Profit Powerhouse for more financial insights. We're here to help you stay ahead of the curve with the latest market trends and strategies. Drop your questions or thoughts in the comments. I'd love to hear how you're navigating the market right now.